Markets are mixed this morning, with attention now turning to the Fed's rate decision tomorrow. And Australia's Q2 inflation data later today will provide a big clue on whether the RBA can cut rates next month. That's coming up in our 5 Things in 5 Minutes on Wednesday, July the 30th. And then in our deep dive interview, ANZ Economist Aaron Luk unpacks a big rise in insolvencies in Australia's hospitality sector.
We do think that subdued discretionary spending that we've been seeing in 2025 so far has really affected the sector.
But first, in 5 and 5 with ANZ, global markets are mixed this morning as attention now turns to the US rates decision early tomorrow morning Sydney-Melbourne time. ANZ senior international economist Tom Kenny says ANZ Research is expecting a hold.
With labour market conditions near full employment, most Fed officials want to wait and see how tariffs impact inflation. With inflation elevated and above the 2% target for some time, Fed officials are concerned that tariffs could lead to an unanchoring of inflation expectations and thus be a source of persistent price pressures rather than a one-off hit to the price level. At least one FOMC voting member, Governor Waller, has indicated that he will vote in favour of a rate cut as he is wary about some softening in the labour market. It's possible Governor Bowman will join Waller in dissenting. If she does, that will be the first time since the early 90s that two governors have dissented. Our expectation is that the Fed should be in a position to cut rates at the September meeting.
As of 4 a.m. Sydney-Melbourne time, the S&P 500 and NASDAQ were both down 0.2%. The 10-year US Treasury yield fell 10 basis points to 4.33% on hopes the US Treasury will limit supply of new long bonds by issuing Treasury notes instead. Gold rose 0.5% to $3,384 an ounce, while West Texas oil futures rose 3.6% to $69.10 a barrel. The US dollar index rose 0.3%. The Aussie dollar fell 0.1% to 65.12 US cents. The Kiwi fell 0.3% to 59.55 US cents. Number 2, the Bank of Japan has a rate decision on Thursday. Tom expects Bank of Japan policymakers will also hold to assess the effects of tariffs.
Our view is that the Bank of Japan can hike again this year as the underlying fundamentals are encouraging. Corporate profitability is near record levels. This is good news for business investment and provides businesses with a handy buffer to absorb the effect of higher tariffs and sturdy domestic wage growth. The labour market in Japan is extremely tight, and this is leading to a virtuous cycle between wages and services inflation. This should give the Bank of Japan comfort that their 2% inflation target can be sustained. We expect the Bank of Japan to raise rates by 25 basis points at the October meeting. The risk to our view is that this gets pushed back owing to heightened domestic political uncertainty.
Number 3, Australia's June quarter CPI inflation data today will be closely watched for signals for whether the Reserve Bank of Australia can cut rates in August. ANZ is expecting a headline annual rate of 2.1% and the trimmed mean at 2.7%. ANZ head of FX research, Marja Ben Zaman, says a softer number could drag the Aussie dollar down.
I do have the Q2 CPI, which is the focus here in Australia this week. And you know what? If we do get a softer figure than expected, that could weigh or claw back some of the gains that we have seen so far.
Number 4, the ANZ Roy Morgan survey of Australian consumer confidence rose 0.4 points last week. ANZ economist Sophia Angala says the main upward movers were perceptions of current financial conditions and economic confidence.
That more stable performance last week may have been driven some increased optimism about the economy on one hand, where if you look globally, there were an array of trade deals reached by the US and other trading partners over the past week. While on the other hand, confidence in financial conditions have weakened compared to where they were in early July. And that might have been due to the RBA's surprise decision to hold the cash rate, just given how widely expected a rate cut was by the market and also the public.
Number 5. Sophia says, though, that upward momentum and confidence has stalled recently.
Overall, on a 4-week moving average basis, the consumer confidence headline series has moved within this tight range of just 3 points, 85 to 88 points since October of last year. So it appears that upward momentum that we got from those Stage 3 tax cuts flowing through to household disposable incomes has stalled. What could have been driving that softness there could have been partly the RBA's surprise decision to hold the cash rate in July, but also just ongoing trade policy uncertainty globally just may have kept confidence from rising.
Sophia Engala there. Now, in our deep dive interview, ANZ's Aaron Luk has been reviewing insolvency data for Australia's hospitality sector as consumer spending has struggled to lift this year.
So, insolvencies in the Australian hospitality sector has received some media attention lately. There's been some news reports about cafes closing down, how restaurants are having it tough at the moment. So, I thought that it's worthwhile looking into hospitality sector a bit more. So, the data that we got from the Australian Securities and Investments Commission does show that insolvencies in accommodation and food services picked up 20% over the year to June 2025. Now, 1,200 businesses across the sector also became insolvent in the first half of the year, with the number of insolvencies in June 2025. Now, that's below the peak that we were seeing in September 2024, but it's still much higher than what we were seeing pre-COVID, and that was around a monthly average of 75. The hospitality sector is also the industry with the second highest level of insolvencies, and we do think that most of these insolvencies likely came from small and medium businesses as well.
So what's the underlying driver here? Why can't these businesses turn a profit and keep going?
Look, we do think that subdued discretionary spending that we've been seeing in 2025 so far has really affected the sector. Adjusted for inflation, consumption on hotels, cafes, and restaurants, that fell 0.1% in the first quarter of the year, and that has really translated to weak turnover for the sector. So looking into the two subsectors, accommodation turnover fell 1.4% in the first quarter of the year, and food services turnover also fell 1.1% in the quarter as well. Looking at the sector as a whole, profits across hospitality declined 7.8% annually, and profit margins also fell from 9.6% from a year ago to now 8.7%. At the same time, I do think that the slow recovery we are seeing in international tourism has affected the sector as well. Look, there's been a slow return of Chinese tourists, and in the past, that's been a larger source of inbound visitors, and that has created some issues because typically Chinese tourists typically do spend roughly twice as much as other tourists. On the domestic front, Australian households are also spending less on domestic trips as well. Compared to pre-COVID, spending on domestic day trips is down 19%, and overnight trips is also down 2% as well.
And on the supply side, if you like, how much of an issue is finding staff and obviously paying them an amount that allows a firm to make a profit?
Yeah, look, we do know that labor shortage is the issue for many industries, and in particular, we are seeing that in hospitality as well. It's eased from 60,000 in 2022 to now 38,000 more recently, but it's still much higher than pre-COVID of around 15,000. It's also a bit concerning because even though the sector only accounts for roughly 6% of the workforce, it actually accounts for 11% of total job vacancies. And in particular, we find that chefs and cooks are in really high demand at the moment.
And the other thing is domestic tourism. What's going on there with the spending on domestic day trips and also overnight trips domestically?
Look, like I was saying earlier, people aren't just spending as much on traveling these days. We do find that people are spending more relatively to the total consumption, a bit more experiences, so like dining out and drinks, etc. But on accommodation itself, people aren't traveling as much these days. So there's a kind of split between what's happening between the two. So we find that for food services, that's doing relatively well in terms of turnover. But when it comes to accommodation, we do find that the number of businesses over time has been decreasing. But at the same time, we do find that job numbers have actually been recovering in the accommodation subsector since 2024. That points to market consolidation. And we're seeing some operators absorbing the available labor. Whereas, again, when we're talking about food services, look, I think turnover has been relatively steady, but what it also tells us is that even though insolvencies have been rising, we actually are seeing a net increase of businesses into the sector as well. So we saw about 435 new businesses in the subsector in the first quarter of 2025. So entrepreneurial activity is still pretty high. And with that, you would expect that with rising insolvencies, you would think that employment would go down. But really, employment in the subsector only fell by about 0.5% annually. So it does look like that businesses, the new businesses, are offsetting some of the negative impact on employment.
Aaron Luk there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, July the 30th. Catch you tomorrow with the latest from the FOMC on that Fed rates decision. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.